Volatility is the name of the game in commercial real estate right now, and after 2 years of one of the biggest bull runs we've ever seen in the industry, things are finally starting to shift in a few big ways. Real estate pricing tends to lag valuation changes of more liquid assets, and even though interest rates and even public REIT pricing can change extremely quickly, the private real estate markets need time to adjust and agree on valuations to get deals done. But over the past few weeks, we've started to see some interesting data come out that's beginning to show how this market is shifting and even reversing some of the trends we've seen over the last few years, several of which are starting to have a direct impact on things like rents, pricing, and even how deals are being capitalized on both the debt and equity sides of the equation. So to highlight some of the biggest shifts that are going on in the industry right now and how these things are impacting the commercial real estate market, in this video, let's talk through two of the biggest changes that we've seen so far in 2022, why each of these things are happening, and the potential impacts that these changes might have going forward on commercial real estate investors and investment management firms. So the first thing on this list that's worth noting is related to an asset class that has been one of the most, if not the most popular commercial real estate product type over the last decade. And this is that in many markets across the country, supply has finally started to outpace demand in the multifamily sector specifically. Net absorption is a metric used by commercial real estate investors to measure the total commercial square footage or total number of residential units that become physically vacant and physically occupied during a certain time period. And this figure is a great way to get a sense for the supply and demand dynamics in a market, whether people are moving into or out of a specific area, and also the demand for newly built product that's recently been delivered in the market. And according to data from CBRE's Q2 2022 US multifamily figures that were released at the end of last month, for the first time in almost 9 years, the multifamily market actually saw negative net absorption at the national level of 38,700 units. And this is likely due in large part to the huge influx of new supply we've seen in the market recently, with 307,000 units being delivered in just the last 12 months, which represents the highest national amount on record since the 1980s. And even with strong demand for multifamily product and many renters currently being priced out of the single-family home market, with over 700,000 multifamily units under construction as of July of this year on a national level, we're very likely only seeing the beginning of what could be a negative net absorption trend across the country. And this figure is even more impactful due to the timing of these results, since the multifamily sector generally follows seasonal leasing trends, with activity usually at its highest in the spring and early summer, which traditionally makes Q2 the strongest leasing quarter throughout the entire year. But if we're seeing negative net absorption figures now, this could spell even worse news heading into Q3 and Q4. And if we zoom in on the timing of these figures and look for the last time that we saw negative net absorption in the second quarter of any given year, we'd have to go all the way back to the middle of the dot-com bust in Q2 of 2001. Only 16 of the 69 markets tracked by CBRE saw positive net absorption in Q2, with New York, Minneapolis, and Boston leading the way, and several other major metros also making the list, including Atlanta, Nashville, Seattle, and Austin. However, New York, Minneapolis, and Boston were the only cities on the list to see positive net absorption figures of over 1,000 units, and other major metros saw significantly bigger losses, with Miami at negative 1,000 units, Chicago and Phoenix each at negative 2,400 units, Los Angeles at negative 3,500 units, Houston at negative 5,500 units, and Dallas at negative 5,800 units for the 4 quarters ending in Q2 of this year. And on the revenue side of the equation, all this new supply is starting to have a real effect on multifamily rent growth, with a July Yardi Matrix multifamily national report showing that month over month asking rents from June to July of this year increased by only $10, representing a 7.3% annualized growth rate, which is down significantly from the 12.6% year-over-year rent growth we saw back in July and the 15.2% year-over-year rent growth that was posted back in February. Overall, multifamily supply is finally beginning to outpace demand in many markets across the country, which is starting to put the brakes on some of the record high rent growth we've seen over the past few years. And for investors that are involved in the multifamily sector, especially those involved with new development projects, or for investors that are active in markets without significant supply constraints, this is definitely something to keep an eye on throughout the rest of the year. Now, aside from just changes to the multifamily market, we've also started to see some changes to the commercial real estate financing landscape across all asset classes throughout the industry, and this has been true for lenders, but also equity investors in both the public and the private markets. According to data from CBRE's Q2 2022 US lending figures, a year ago, alternative lenders, including debt funds and mortgage REITs, made up almost 45% of the non-agency commercial real estate lending market, but in Q2 of 2022, that figure dropped to just 32%, and CMBS lenders have also pulled back significantly over the last 12 months, accounting for 17% of commercial real estate loans in Q2 of 2021, but just 4% of total non-agency loan volume in Q2 of this year. And while these lenders that have traditionally been more risk-on in their investment strategies are starting to pull back in this market, more conventional players in the debt space are starting to become significantly more active, with banks taking over the top spot in the industry in Q2, closing 38% of all non-agency loans tracked by CBRE, and life companies almost tripling their market share from a year ago, up from 11% in 2021 to 26% in Q2 of this year. And at the same time that interest rates have ticked up throughout 2022, spreads on commercial real estate loans have also widened recently, with the spread on commercial mortgages averaging 187 basis points in Q2 of this year, up by 29 basis points from Q1, and the spread on multifamily mortgages jumping to 172 basis points in Q2, up by 28 basis points from the previous quarter. And the spread on commercial real estate loans is important because the all-in interest rate that a borrower ultimately ends up paying is made up of a base index number, which is usually going to be the risk-free rate in the market, plus that lender's spread, which is really the lender's risk premium on the loan, essentially representing the compensation the lender is looking to take in exchange for the inevitable risk associated with a commercial real estate investment. And when the index rises, as it has throughout the majority of 2022, and the spread rises at the same time to compensate lenders for increased levels of volatility in the market, this can lead to significant increases in all-in interest rates for borrowers, which is what many commercial real estate investors have seen in recent months. And on the equity side of the equation, we're also starting to see shifts in the private market for commercial real estate assets, with buyers and sellers finally starting to adjust to the economic changes we've experienced this year. In commercial real estate, there's something called the bid-ask spread, which essentially represents the difference between what sellers expect to sell their properties for when they're marketed for sale and what buyers are willing to pay for those same marketed properties at any given time. And over the past few months, that bid-ask spread has been at its highest levels in years, but for many of the reasons mentioned earlier on in this video, including higher interest rates that have made it more difficult for buyers to hit their target returns at 2021 pricing levels, we've started to see a thinning out of the buyer pool, reductions in offer prices, and investors sitting out of the market completely, or at least being more selective on the deals they choose to pursue. CBRE reported in their Q Q2 2022 US capital markets figures that institutions and REITs both pulled back on their overall investment volume in Q2, dropping by 7.9% and 5% year over year respectively, and REITs, cross-border investors, and private investment firms were all net sellers in the second quarter of the year. And in the private markets, anecdotally, I've personally also seen a significant amount of companies that have struggled to raise equity for their deals over the last 3 to 6 months, which is very likely the result of many high net worth individuals and family offices taking a wait and see approach at this stage of the cycle. Ultimately, right now, we're seeing some significant changes to the supply and demand dynamics in the commercial real estate markets and some big shifts in the capital markets among debt and equity players in the space, and each of these things could end up having a big impact on the commercial real estate industry throughout the rest of the year, and could also open up a significant amount of opportunities for investors that are ready to capitalize on these in 2023. And if you want to make sure you're ready to analyze those opportunities that might come your way over the next 6 to 12 months as things continue to shift in the market, and you want to learn the financial modeling and analysis process used by some of the biggest real estate investment and development firms in the industry, as always, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, our entire library of pre-built acquisition, development, and waterfall models for multifamily, industrial, office, retail, and mixed-use deals, and you'll also get access to private one-on-one email-based career coaching if you're looking to break into the industry and want some additional guidance and feedback along the way. And if you like this video and want to see more content on this channel on what's happening in the market and where things might be headed in the future, make sure to hit the like button and let me know. And let me know in the comments any other indicators you're watching right now that could impact the market throughout the rest of the year. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.